A company can be wildly profitable and still go broke. The page that tells you which way it's heading is not the one everybody quotes. Last episode, we read the income statement, a year of trading compressed onto one page. Think of that as a film. The balance sheet is something else entirely, a photograph taken on a single day of everything the company owns and everything it owes. A film tells you how the year went. A photograph tells you whether the company can survive the next one. So here is the whole page, in one line of arithmetic that never breaks. What a company owns equals what it owes, plus what the owners are left with. That's it. Every balance sheet ever published is that sentence in more detail. Put a real company in it. Apple, on the last day of its financial year, September 2025. Round numbers and read them as proportions rather than sums, because the sums stop being true the moment the next quarter lands. Of everything Apple owned that day, about a fifth was left over for the owners, which means roughly 4/5 of that company was other people's claims on it. Sitting on the other side of the page, cash and investments worth about 37% of everything it owned, and inventory, actual phones in actual boxes, worth under 2%. Now the three questions in the order a lender asks them. Question 1. Can this thing pay what's due in the next 12 months? For that, you only need 2 rows. What's owned that turns into cash within a year against what's owed within a year. Divide the first by the second, and you have the oldest ratio in finance. Above 1, the near-term bills are covered by near-term assets. Below 1, they are not, at least not on this page. Apple's number that day was 0.89, below 1. By the textbook, that is a company with a problem. By any sensible reading, it is the opposite. And understanding why is the moment you stop reading a balance sheet like a form and start reading it like an owner. Because a ratio under 1 can mean 2 completely different things. It can mean a business is running out of room, or it can mean a business is so powerful that it gets paid before it pays. Here's the machine underneath that. A supplier ships Apple components and waits to be paid. A customer buys a phone and pays that day. Money comes in before it goes out, so the gap between the two is funded by everyone else. That is what negative working capital means, and it is a privilege, not a warning. Costco does the same thing with groceries, sells the food long before it settles with the farmer, so the sign flips depending on who has the power. Weak companies are squeezed by that gap. Strong ones are financed by it for free. Question 2. Whose money is actually in this business? Split the right-hand side. Borrowed money has to be repaid on a date somebody else chose. Owner's money has no date at all. The proportion between them tells you how much freedom a company has when things go wrong. Apple owed about 1.5 times as much debt as it had owner's capital, which sounds heavy until you notice it also held enough cash and investments to clear most of that debt outright. Gross debt frightens people. Net debt, what's owed after the cash you already have, is the number that decides anything. Question 3, and the one almost nobody asks. Is what it owns actually real? Because assets are not equal. Cash is cash. A customer's promise to pay is nearly cash. Inventory is a hope with a shelf life. And then there is goodwill, the number a buyer writes down when it pays more for a company than that company's own assets are worth. Goodwill is not a thing. You cannot sell it. It sits there until one day the company admits the acquisition didn't work and writes it off in a single line. Apple's goodwill on that page was 0. A company of that size that has barely bought anyone is telling you something about how it grows. One last line, because it catches people out. Apple's retained earnings, the pile of profit a company has kept since the day it was founded, was negative. A company printing more profit than almost any business in history, showing less than nothing kept? Read it properly, and it isn't alarming at all. It means Apple has handed shareholders more than it earned in the years since, buying back its own shares and paying dividends faster than the profits arrived. A negative there can mean a company has burned through everything. It can also mean it has given everything back. The page will not tell you which. The rest of the statements will. So that is the whole discipline, and it takes about a minute per company once it's a habit. Can it pay this year's bills? And if the ratio looks bad, is that weakness or power? Whose money is in it after netting off the cash? And is what it owns real, or is a chunk of it the price of somebody's old ambition? 3 questions, always in that order. Master those, and you will read a balance sheet better than most people who quote them for a living. Next in Read the Numbers, the cash flow statement. The one that catches the lies the other two can hide.